Hey everyone, Andrew here from Property Association. So the Reserve Bank has come out with a document this month talking about the Australian economy and financial markets, and I wanted to use that, and I'll include that, to talk about what has got us into this predicament in regards to property, especially in our major cities as we see it at the moment. So what I want to draw attention to is the first minute, very quick summary, and then I'll get into details. So if you just want a quick snapshot, I'll get through it quickly. The analogy is basically that we were fed a drug. That drug was credit, and it was fed to us in high amounts. And when we had the drug, we got the munchies, and to feed the munchies, they approved a lot of high-rise and high-density dwellings, and we went out and consumed. And now our dealer has pulled away the credit, and we're left to basically go and buy our munchies with what we have, which is our wages, and they've hardly moved. And as a consequence, now we're seeing that correction because we just simply haven't saved money, and we've been living off other people's money. So that's the snapshot. Now, getting into some detail and looking at some facts and figures, the one thing I want to say is if you look at our household debt in terms of where it is and in terms of property prices, you'll see that our household debt, when it comes to our disposable income as a ratio, it's actually increased more than what our housing prices have. So what that says to me is that it's not that we were just spending our credit on housing. So it's not just housing, we'd be spending on a lot of other things. And it's quite dangerous when we find that our debt is increasing as a ratio to our disposable income faster than housing prices. So that's one of the key factors there. I also want to bring into effect that since the early 2000s, that the credit has sort of gone from loans to investors from $5 billion up to 2015, when really we started to see the peak of people's activity in the property market, to 15 billion. So it's, again, that's where we can see the credit injection for the last boom being so strong. And if you can see the graph, you'll notice that overall loans have also went through the roof. They started to pull back, but they definitely went through the roof. If you look at, and I'm making some notes here, our wages. So once the credit was pulled back, which is what's happening now, we're left with essentially the money that we have, which is our wages. But again, from the 90s sort of to now, we've seen anywhere between 1.8 to 4.4% increase in wages. So it's about an average of 3%. At that rate, what will happen is it will take about 33 years for the income to double. Whereas in 33 years, property has doubled, and doubled again. So that in itself is very problematic because our wages just are simply not keeping up with the growth of our property prices. To help in that regard, yes, you can see that interest rates have come down, and so therefore it allows us to service more debt. However, what I come back to, which I find is very interesting, is that even though our interest rates have fallen to allow us to accommodate more housing debt, what we've actually done is accommodate more debt in total. So that's why I think this graph is quite important. And why I think it's so important is you can see it's supported with our liability growing more than our net wealth. So in the same period that our household debt has increased faster than housing prices, we've also seen our liabilities increase faster than our net wealth. So you'd assume after a big boom, which we've had in property prices, maybe our net wealth would be stronger. But what it's showing is that our liabilities in general have again increased more than our net wealth. So to put it simply, as a nation, we're going backwards, and we've been going backwards. And I'll put it down basically to living it up on credit. So again, love to get some feedback, love to get comments. Let me know if this stuff's interesting or value, and we'll keep coming up with some more. The next will be in terms of getting specific, using specific people as examples to help bring relevance to what we've been talking about in the last week. Thanks.